Hey, what's up, guys? So, given the current state of affairs that we're in with the financial markets, there may be actually a lot of companies that may be trading under their intrinsic values. And given that, I wanted to look into the historical record at some older academic papers on value investing. Specifically, there's this paper called Value Investing: The Use of Historical Financial Statement Information to Separate Winners from Losers. So in this paper, it was published by a professor named Joseph Piotroski. I believe I'm pronouncing that correctly. And he posed the question on if you could look at financial statement analysis variables and determine future returns going forward. So this paper was published back in 2002, I believe. And if we read through this, in the abstract, he states, this paper examines whether a simple accounting-based fundamental analysis strategy, when applied to a broad portfolio of high book-to-market firms, can shift the distribution of returns earned by investor. So there's a caveat here. He specifically looked at a broad portfolio of high book-to-market firms. So what are high book-to-market firms? Let's take that apart. So book-to-market, what is book? Book, also known as book value, is essentially just the shareholder's equity on a balance sheet. That's the total assets minus the total liabilities. So that's that value there. And then market, obviously just the market value. So book to market is equivalent to, a high book to market is equivalent to a low price to book value per share. And I say price to book value per share, that's the stock price divided by the book value per share. So if we go through this paper, we can see that he shows that the mean return earned by a high book-to-market investor can be increased by at least 7.5% annually through the selection of financially strong high book-to-market firms, while the entire distribution of realized returns is shifted to the right. So, in addition, an investment strategy that buys expected winners, that is, the expected winners his methodology distinguishes, and shorts expected losers, generates a 23% annual return between 1976 and 1996. So it appears the strategy is robust over time and it controls for other investment strategies. So the main idea behind this paper is if you can actually take a portfolio of undervalued companies, that's high book to market firms, and see if you can use financial statement analysis to separate these higher performing portfolios in the future and lower performing portfolios in the future. It's interesting to note here, the benefits to financial statement analysis are concentrated in small and medium-sized firms, companies with low share turnover, and firms with no analyst following. This superior performance is not dependent on purchasing firms with low share prices. So what I'm going to do is, in this paper, he goes through some of the specifics on how to separate these winners from losers. And then we'll go through this paper, and then in my next video, we're going to actually try to code this in Python. So finally, overall, the evidence suggests that the market does not fully incorporate historical financial information into prices in a timely manner. So he's stating this because in traditional efficient market hypothesis theory, or efficient market theory, you can't, in strong form, that is, you can't actually use fundamental analysis to make predictions of the future. There is no edge there. There's no alpha that can be produced. The idea is that everybody has access to that fundamental information. But he argues in this paper that since these companies have been beaten down, that is, they are value companies. For example, when I say beaten down, they have a high book to market ratio, essentially. And what does that mean? It means the price, the denominator in that ratio, is smaller or has fallen down dramatically. So his reasoning is that these companies that have been sold off for several reasons, maybe because of distress or the market outlook for that specific company is negative, etc. Those companies have been overlooked. Therefore, since they've been overlooked and they're weak, there's a potential edge in looking into their financial statements to see if they actually are truly strong companies that could outperform in the future. So that's the whole premise of his paper. So let's continue on. So here we go. High book-to-market firms offer a unique opportunity to investigate the ability of simple fundamental analysis heuristics to differentiate firms. Here we go. First, value. First, value stocks tend to be neglected. As a group, these companies are thinly followed by the analyst community and are plagued by low levels of investor interest. So this is important here. Again, when we're looking at these financial statements and determining strong ones versus weak financial statements, the caveat here is that these are we first have to work with a universe of companies that have low levels of investor interest, that aren't heavily followed by the analyst community. Because the whole idea is that these are unloved stocks that aren't interesting, and since there isn't an efficient market here, there isn't much analyst coverage following these particular securities. It's an inefficient market, and we can use fundamental analysis to have an edge into the future of future returns. So given this lack of coverage, analyst forecasts and stock recommendations are unavailable for these firms. Second, these firms have limited access to most informal information dissemination channels. So what does he mean by that? Information dissemination channels. So he's talking about when this company publicly makes available any new information about itself, it does not disseminate equally across into the public markets. So he also states here their voluntary disclosures may not be viewed as credible given their poor recent performance. So that's interesting there. I don't know if I agree or disagree, but that is an interesting point. Therefore, financial statements represent both the most reliable and accessible source of information about these firms. Interesting. So, third, high book-to-market firms tend to be financially distressed, like we stated before. As a result, the valuation of these firms focus on accounting fundamentals such as leverage, liquidity, profitability trends, and cash flow adequacy. These fundamental characteristics are most readily obtained from historical financial statements. So essentially, this whole paragraph is just stating, like we said before, these are companies that are overlooked. They have been beaten down because of distressed reasons, outlooks negative on them. They're not followed by the analyst community. Therefore, this is a universe of companies that are trading inefficiently. And since they're trading inefficiently, we can use financial statement analysis to make projections and have an alpha or edge into the future of future returns between strong and weak firms. He states here, I show the success of the strategy is based on the ability to predict future firm performance and the market's inability to recognize these predictable patterns. So again, these predictable patterns are the financial statement analysis that we're going to perform and hopefully code into in my next video. Firms with weak current signals have lower future earnings realizations and are 5 times more likely to delist for performance-related reasons than firms with strong current signals. He provides evidence that the market is systematically surprised, quote unquote, by the future earnings announcements of these firms. And that may be because since these are unloved companies and they're not heavily followed, when there is any good information about it, the market is very surprised about it. So he goes on to state some other historical papers, famous papers by Fama and French. And, Fama and French they're famous for showing that a portfolio of high book-to-market firms outperforms a portfolio of low book-to-market firms. And the reasoning behind that, they find, is that that book-to-market is characterized as a variable capturing financial distress, and thus the subsequent returns are represent a fair compensation for risk. So the idea there is, since these are distressed firms, they're higher risk, and therefore you should have higher return. So that's the whole idea behind high risk, high return. So you should be compensated for that risk. So here he states the average high book-to-market firm is financially distressed. This distress is associated with declining or persistently low margins, profits, cash flows, and liquidity, and rising and or high levels of financial leverage. So he states on, intuitively, financial variables that reflect changes in these economic conditions should be useful in predicting future firm performance. He chose 9 fundamental signals to measure 3 areas of the firm's financial condition. So those 3 areas are profitability, financial leverage / liquidity, and operating efficiency. So he goes through each of these and then he classifies them as either good or bad, 1 or 0. And then he adds them up and puts them into something called an F score. And therefore, an F score of 0 would be a financially weak company. An F score of 9, which is the highest F score, would be a financially strong company. And his idea is those are the losers versus the winners, and would determine future performance. And again, the caveat is these are high book-to-market firms, or firms that are quote-unquote value companies and have been financially distressed. So we're going to go through the first one, profitability. And I want to state one other thing. The idea behind looking at these financially distressed quote-unquote value companies that have high book-to-market ratios, we're assuming that the market doesn't know this. We're assuming that since these companies have been sold off and the book-to-market ratio is very high, we're assuming that these are inefficient companies, and the market doesn't know that the market doesn't know that there are some gems or good companies in these distressed portfolio of companies. But we could push back and say maybe the market does know that. That's why they are significantly distressed. That's why they have been sold off. That's why we do have high book-to-market ratios. The market knows that these are weak companies, and therefore they should have weak future returns. So we need to understand that. But again, we're assuming that this universe of companies is financially distressed and therefore has less analyst coverage and less interest. So that's the premise of this paper. So let's go through each of these signals. So he looks at 3 again. So the first one is profitability. So given the poor historical earnings performance of value firms, and before I go through this, I'm just going to go through the ideas behind each of these variables. I'll go into the details of calculating these in my next video when we actually code it in Python. So we're just going to get the idea behind the premise or the economic reasoning behind these variables. So profitability. So given the poor historical earnings performance of value firms, any firm currently generating positive cash flow or profits is demonstrating, according to Piotroski, a capacity to generate funds through operating activities. So that makes sense. I mean, a strong company that can generate funds, that's a good thing, right? If they can produce cash flows, which is probably more important, and then obviously profits or net income. And he defines these as net income before extraordinary items and cash flow from operations, which you can get from the cash flow statement. So we're gonna have to code into our Python. We're gonna have to look at balance sheets, cash flow statements, and income statements together. So again, he assigns a value of 1 if it's positive, or a value of 0 if it's negative. So we'll continue on. He also looks at something called accrual. So he looks at the relationship between earnings and cash flow levels, just considered. So he shows that earnings driven by positive accrual adjustments, that is, what he means by that is those are profits that are greater than cash flow from operations. So that's usually a negative, and usually just because a company has positive net income or earnings, it does not entirely mean that they have positive cash flows. And that should be a red flag or something that you need to look deeper into and understand why is that. Why on the income statement it shows that you do have net income, but on the cash flow statement you had a cash outflow. And so he looks at this relationship, and maybe in another video I'll go specifically more into that whole idea of what accruals are. But he specifically looks at this relationship may be particularly important among value firms, where the incentive to manage earnings through positive accruals, and that's what I was implying earlier, that you can manage earnings using positive accruals. And again, what are positive accruals? What are different types of accruals? That's accounts receivable. That's depreciation. Those are all different types of ways where you can manipulate, and even taxes, tax rates that can manipulate the bottom line. So he goes on to state again that the incentive to manage earnings through positive accruals is strong. So essentially what he's doing here is he defines the variable as accrual, and he wants to make sure that cash flow from operations is greater than the return on assets. And return on assets is just the net income divided by the total assets on the balance sheet. So he believes that's a stronger indicator of a company can actually produce cash flows and isn't manipulating the income statement. So the next indicators he looks at are financial performance signals. So we look at leverage, liquidity, and source of funds. So let's first look at leverage and liquidity. So leverage, he defines, the reason why we're going through leverage is since most high book-to-market firms are financially constrained, he assumes that an increase in leverage and a deterioration of liquidity or the use of external financing is a bad signal about financial risk. That's his assumption he makes here. So the idea here is, what if a company is financially distressed, they may need to raise more debt. They may have their current assets may not be greater than their current liabilities, which means that they can't service their short-term obligations. Those are all the different factors to look into. And he's also looking at use of external financing. So he looks at long-term debt levels. So he measures the historical change in the ratio of total long-term debt to average total assets. So the idea here is by raising external capital, a financially distressed firm is signaling to the market its inability to generate sufficient internal funds. So meaning that it cannot grow organically. Its cash flow from operations isn't strong enough to grow organically. It needs to raise cash by external factors, external financing, instead of by selling product and making money that way. In addition, an increase in long-term debt is likely to place additional constraints on the firm's financial flexibility. So he goes into defining those variables there, and again, we'll try to code those up and go into detail later in my next video. He also looks at the historical change in the firm's current ratio. So again, the current ratio is just your current assets on the balance sheet divided by the current liabilities, and it just shows the ability or odds of paying off your short-term obligations. So, and again, what are current assets? That's like your cash, that's your inventories, your current liabilities, that's your short-term debt. So again, he assumes that an improvement in liquidity is a good signal about the firm's ability to service current debt obligations. Okay. And then finally, he looks at equity offers. So that's the variable that he defines there. And the idea here is that financially distressed firms that raise external capital, that is, issue equity, could be signaling their inability to generate sufficient internal funds to service future obligations. It's the same idea behind issuing debt. They should be able to generate their own cash without increasing debt or equity. And again, the caveat is these are financially distressed firms to begin with. This isn't Apple. This isn't companies that are trying to grow into the future, for example. The assumption is these are distressed firms already. This is a universe of distressed firms. So it's a signaling that they're even weaker and they can't produce organic cash flows. So moreover, the fact that these firms are willing to issue equity when their stock prices are likely to be distressed, they're also going to have high cost of capital, highlights the poor financial condition facing these firms. All right, and then finally, we're looking at operating efficiency. So the remaining two signals are designed to measure changes in the efficiency of the firm's operation. So he's going to look at gross margins, I believe. So change margins, that's the firm's current gross margin ratio. And gross margin, again, that is just gross margin divided by total sales, that's what he's looking at. And so when you look at your income statement, you're going to have your total net revenues minus your cost of goods sold, and then finally your gross margin. An improvement in margins signifies a potential improvement in factor costs, a reduction in inventory costs, or a rise in the firm's product. So that's a good thing. So that's the economic reasoning behind that. And then finally, he looks at turnover. He looks at a firm's current year asset turnover, and that's just your total sales divided by your total assets, or in this case, beginning of the year's total assets. So he's looking for that to improve, that ratio to increase. And the idea behind that is an improvement in asset turnover signifies greater productivity from the asset base. So such an improvement can arise from more efficient operations. That is, it has fewer assets generating the same level of sales. So that's the idea there. Or it could also mean that an increase in sales, which could also signify an improved market conditions for the firm's product. So the asset base stays the same, but there's an increase in sales. So that ratio increases. So finally, this is the F-score that he calculates. He gets each of those variables, about 9 of them, and he adds them up. And again, like I said, it's 0. It can range from 0 to 9, 0 being a weak identifying a weak firm that does not satisfy each of these variables, and a 9 satisfying all these variables. That's a F-score of 9, which should be a financially stronger firm. So that's it. So, in my next video, I'm going to actually code up each of these signals or variables using an API called IEX in Python. And then hopefully the idea would be that we can just, first we have to create our universe. If you have a universe of companies that you're interested in. But the idea would be this code, you just put in a ticker and then would be able to calculate the F-score and see if it outperforms or underperforms. And usually the idea would be this is just a screener for the companies that we believe could outperform or underperform into the future. So if you like this video, please subscribe. Till next time, guys. Thank you.